Our next guest sees, well, disappointment ahead. Joining us now, Chris Senyek from Wolfe Research. Your base case is an 8% drop. Why so bearish?
Yeah, hi, thanks for having me on. So we think the lagged impacts of the Fed rate hikes are going to really start to hit the economy in the first half of next year. At the same time, companies are going to lose some of the pricing power because, inflation coming down is a double-edged sword. Companies won't be able to pass through the prices they had, and since earnings and the economy is priced in nominal terms, you just won't get the revenue growth that we've seen over the last 2 years. So we're penciling in 3% earnings growth for next year, which would give us a 230 S&P 500 earnings number. And we think that higher risk aversion will come into the markets in the first half of next year, and multiples will contract from the 19 times forward earnings the S&P trades at today to something closer to 17 times, which is in line with its pre-COVID average.
Okay. A lot of that case, though, sounds like the bear case for 2023 that didn't pan out for the bears. So what happens if the Fed actually does cut around mid-year? Does that change the direction of equities?
Well, just like rate hikes, rate cuts work with the long and variable lag, right? So if this is a 94-95 scenario and the Fed cuts in time, and that causes financial conditions to loosen further and consumers to spend money, then we could see some upside to that. But we're not in that camp. We think this cycle has been a very different one. We don't see the Fed cutting interest rates when the unemployment rate's at 3.7%. We think, you had the COVID bump, you had excess savings earlier this year, and then you had the Fed come to the rescue in March, which threw a lot of liquidity and enthusiasm, including AI, into the marketplace, and he threw some fiscal stimulus on top of it. So we just don't see those forces which cause the economy to surprise the upside occurring in 2024.
You sound like somebody who is very skeptical of a soft landing scenario next year. Are you building recession into your base case? And if so, what does that mean in terms of how you position yourself as an investor?
Yeah, so as we enter, next year, in a way, it's a mirror image of this year, right? This time last year, everyone was bearish. Everyone thought the economy was going to go into recession in the first quarter, and it just didn't happen, right? The consumer surprised to the upside because I think you had excess savings among some other things. As we enter 2024, it feels like sentiment is off the charts positive. We've had this performance chasing rally that's broadened out more recently. And yet the economy is slowing, and you're seeing data points almost each and every day that things are slowing at the margin. It takes time. You don't have a big cathartic event at once, which causes, stocks to price in it immediately. But we think as the economic data disappoints, the Magnificent Seven, which are viewed as very defensively now, will start to underperform. And we'd rather own the groups that have lagged year to date. Our favorite sector is staples. We like healthcare. We also like utilities, and we're out of consensus in that we like energy as well.
Interesting. I mean, just to look at the staples they've been hit pretty hard earlier this year. When you talk about the double-edged sword of disinflation, I would think it's going to be groups like this that will feel it first.
Well, they're going to feel it from the top line, but we're thinking about it from a stock perspective, and that they will be a relative, outperformer in a choppy and concerned tape.
So, Chris, it's an election year next year, and a bad economy, a bad stock market wouldn't be good for the incumbent. That's Joe Biden. So if I guess the polls start showing that, and what are the chances that the markets start trading on the polls and that actually messes with the direction of stocks?
It very well could. I think that it's going to be an extremely volatile market next year. I don't think the market's looking to the election because, frankly, I don't think that the market really has a good feel for maybe who the candidates ultimately are going to be. And I think the market's just focused on now to year end right now. But, we saw that in past elections where as the polls swing, the market swings around that, and you see a lot of rotation underneath the surface. One of the things I am worried with their outperform on healthcare is that healthcare becomes a punching bag, if you will, for policy, and that sector will likely be very volatile. So I think that the reality is we're going to have a very volatile year. I think you have to be more nimble. I don't think it's just going to be a buy and hold type year for any investor.